Hey guys, it is June 29th. Mark Coe here for a little June 29th end of June update and wrap up. And I want to focus tonight on levels. Levels, I have to tell you, is the key to everything I do. And I want to show you how this works. And I want to talk a little bit about the um, the basis of which I form my day. And I want to look at S&P because S&P was a great range today. And I want to talk about a couple different things. So just to give a little background, daily model, which is longer term stuff. Daily model has had a short S&P for the last day and a half, and it got a short at 24.27. The stop on the S&P was a daily close above 44. Did not get that, got a touch through it today, so daily model stays short. Intraday, a touch of that would have you stopped out. Regardless, what I want to focus on is where the levels are coming from and what's going on in the short term. It's a focus of most people in my audience. Most of the people listen to me, they tend to be shorter term in nature, and I want to show you kind of how this works. So think about what S&P has done, and if anybody's listened to my analysis, the analysis has been really consistent, which is S&P has been in this trading range, 24.15 on the bottom to 24.40 on the top. We visited above 24.40 twice, but been unable to sustain any gains above that level. They've just not been able to sustain it. Today saw a very similar action on the bottom side, which means we traded down below that 15 and I'm quite certain some shorter term money, some buy money into that dip was easily flushed out. Again, the power of the levels. So think about what I was looking at today. So I'm pulling up my newsletter from the morning, June 29th, and here's what I say in this. I point out the supports. 2427, 2415, which is this big bottom edge that we focus on, and then again 2400. The top side resistance 45, right? Above that 52, which doesn't come into play. And here's what I say: the buyers have to maintain this edge around the 15 level to keep control. Buy zone at 15 to 18. That's short-term money. But think about what's going on here, right? So as we come into the U.S. session. So the resistance level we're using is 45. You can see it marked right here, 45. Trades to a high of 44.75. So it's not a surprise to my viewers or to my readers what we're looking at when we see these levels. On the approach down into 15, this is a 4-hour chart, but let me just show you what it looks like on a faster time frame chart. Same level, right? A lot of times I get the question, what time frame do you trade? It's not about trading time frame, it's about trading levels. That 24.15 area is there on a 4-hour chart, it's there on a daily chart, it's there on a 5-minute chart. So it's not about the time frame, it's the levels. But let me show you in a faster time frame what's happening at this level. What's happening at 15? And let's look at it. We'll talk about some of the difficulty you encounter as a short-term person. There's your 15 level right there. There's your 15. So think about what's going on as you come into 15. Buyers, dip buyers are saying, this is the level, I have to buy against it. There's not a lot of money that's probably hammering into that bid unless you're already short. You could be looking to add. But there's a lot of money that's looking for the dip that says, if this holds, I'll take it and I'll ride it back up. So think about what happens once you get a break below. That's a quick move in the S&P, right? That's 12:30 East Coast time. Within an hour, it trades down 15, 16 points, only to rally right back. Now that move serves to not only frustrate longs that come in and attempt to buy the dip, because short-term money, there's almost no way you held against that 16 points against you. But longer-term money, if you're starting to explore the other side of that, if you're starting to explore shorts, that can be extremely challenging as well, right? To watch a short evaporate against you. So it is a difficult market, equities in general, to trade short against. Not only does your timing have to be phenomenal, but you're fighting a tide, the likes of which doesn't appear in a lot of other markets, right? There's not always natural gold buyers or gold demand. Gold is considered an inflation hedge, or it's considered some type of risk off market. Oils, commodities, a futures market, it's supply and demand. But in equities, most of the world is lined up to be buyers, net buyers of equities. It's extremely challenging in a general market sense to time equity sell-offs. It's not always the case stock specific, But general market, when you're looking at indexes, it can be very challenging to time those and to time them in a sustainable way. But what I wanted to bring the focus to is what's going on at the levels and where to look. And so what my viewers and what my readers of my newsletter will know is that when you're focused on what the breakdown of levels means, this is what this means now at 24.15. This market has to repel to the upside, this 24.15, to keep buy pressure intact, doesn't it? This is a pretty firm break of it that was unable to sustain. So as we come into Friday, it's a 4th of July holiday here next week in the U.S., could see some slowdown in activity. But if this level doesn't hold, what I would say is look out below, meaning that the market got through it. It's now come back to, there's definitely dip buyers. There's short-term buy that BTFD, buy the dip. But there's also the sense of if that dip stops rewarding you, how quickly is money going to turn the other side and say, I don't need this. I don't need this headache. Right? And that's what happens in an equity environment where the world is so used to being central bank support. Right? This was a market that in 2009 I couldn't tell you I had a lot of experience with, because I don't think any of us had ever seen it to this level. Now, 10 years, almost 10 years into it, it's a very different format where people are just expecting and they're conditioned to propping up markets on any dip. So where it gets interesting is the first time that it's not sustainable. And think about where you are, right? Just think about where you've come since November. This is a massive, massive rally. And these are top edges of that rally. So I look at it as an opportunity, and I'm willing to explore the short side. I'm willing to pay several stops away, meaning I got stopped out here. I'll get stopped out at 24.40-ish. I'm willing to attempt that for what I view the downside as. But it's only because of these breaks that start to confirm it, to say, look, it makes a lot of sense to explore it if that market will pay you for being short. To this point, any short side I've had in S&P has been quickly reversed. About the best I can say, and again, what I'm looking to do is get positioned so that there is no more risk on the table. And if the reward happens, great, but I don't want to get hurt along the way. So that's the point of using the levels, why I'm focused on this 24.15 area and what I want to see in terms of close. We did not accomplish a daily close through that level. Haven't done it. You can see just even yesterday's support, or 2 days ago, we haven't accomplished daily closes below that. So my focus as we go into the weekend, I'm still sitting long euros, have been long euros for close to 3 big figures now, 11.44. Sitting now short S&P, so I really need S&P to not be able to rally. Again, I don't, the desire is to obviously not get stopped out. I realize there are going to be some short-term people with tight stops that will have paid stops. But the long-term model is still stay short S&P, and that's the focus as we go into the weekend. So for Marco, it is Thursday night, and again, hope you all have a wonderful weekend and chat with you next week. Cheers.